Today for the SIE exam, we will cover two types of investment companies that often cause confusion: closed-end funds and unit investment trusts, or UITs. Understanding their unique structures is key to answering questions correctly. Let's start with closed-end funds. Think of their creation like an initial public offering for a stock. The fund sponsor determines the investment objective, raises a specific amount of capital by issuing a fixed number of shares in a one-time IPO, and then that's it. The fund is now closed to new capital. From that point forward, those shares trade on the secondary market, like the New York Stock Exchange, between investors. This is a critical difference from open-end mutual funds, which continuously issue and redeem shares directly with investors. Because closed-end funds trade on an exchange, their price is determined by supply and demand, not by their net asset value, or NAV. The NAV represents the per-share value of the underlying assets in the portfolio. However, the market price can, and often does, differ from the NAV. If investor sentiment for the fund's strategy or its holdings is strong, demand can push the market price higher than the NAV, causing it to trade at a premium. Conversely, if the fund becomes unpopular, the market price can fall below the NAV, meaning it trades at a discount. An exam question might ask what an investor pays for a closed-end fund. Remember, in the secondary market, it's the current market price plus a brokerage commission, not the NAV. Now let's look at unit investment trusts. A UIT also pools investor money to purchase a portfolio of securities. But the defining feature is that this portfolio is fixed and not actively managed. The UIT sponsor selects the securities, which are typically stocks or bonds, and places them in the trust. That portfolio is then left alone. There is no portfolio manager making ongoing buy or sell decisions. Think of it as a static collection of investments designed to meet a specific objective, like providing capital appreciation or income from a set group of stocks or bonds. Another key feature of a UIT is its predetermined termination date. When you invest in a UIT, you know from the outset when the trust will dissolve. On that future date, the securities in the portfolio are liquidated and the proceeds are paid out to the unit holders. Investors aren't stuck until the end. They can typically redeem their units by selling them back to the sponsoring firm at a price based on the current NAV of the underlying securities. The exam loves to test the unmanaged nature of UITs. If you see a question asking to identify a non-managed investment company, the UIT is your answer. To keep these two straight, here is a mental shortcut. For a closed-end fund, think of a closed door. After the IPO, the door to new capital is shut, and the fixed number of shares trade between people on the exchange. For a UIT, remember the letters stand for Unchanging Investment Trust. Its portfolio is fixed, unchanging, and not actively managed until it terminates. This distinction is crucial for avoiding common exam traps that try to blur the lines between these products and their more common open-end cousins.